Hello and welcome. I'm Darius Parvin.
I'm Devin Avani.
And I'm Nick Shen.
And in this video, we're going to go over some of your commonly asked questions.
What does hashing mean? A hash function maps an input of some large size to an output of a fixed size. A cryptographic hash function specifically provides special properties which allow us to fingerprint data with a special but pseudo-random identifier. When we say hash function in this course, we mean cryptographic hash function unless mentioned otherwise. The key properties of a cryptographic hash function are, number one, it's extremely easy to calculate a hash for any given data. Number two, it's extremely computationally difficult to calculate an alphanumeric text that has a given hash. And number three, it's extremely unlikely that two slightly different messages will have the same hash. Hashing in the context of blockchains usually refers to mining, as the purpose of mining is to brute force a hash function with numerous inputs. Our second question is, why is the amount of Bitcoin capped at 21 million? The number for 21 million Bitcoin can be calculated from how the block rewards are designed. Satoshi Nakamoto established a 50 Bitcoin reward for each mined block. Bitcoin is designed so that this reward is cut in half every 210,000 blocks, which is roughly every 4 years. Therefore, total Bitcoin production can be written as 50 times 210,000 plus 25 times 210,000, so on, which converges to 21 million Bitcoin. After all 21 million Bitcoin are mined, the network will have to rely on transaction fees to financially reward miners. Our third question is, are smart contracts legally enforceable? Currently, there is no domestic or international legal framework for blockchain technologies or smart contracts. However, it can be argued that smart contracts are self-sufficient and legally binding agreements, and that they have the potential to satisfy various national contract laws. While one key difference is that interruptions of the contract are performed by algorithms rather than computers, experts say that this is legally irrelevant to existing contract laws. The question of whether smart contracts should be legally enforceable is more of a philosophical question. Rather than informally describing an agreement that is enforced by humans, smart contracts allow us to algorithmically describe an agreement that is enforced by computers. Due to the lack of experience we have with this new framework for agreements, perspectives constantly evolve.
Since we generate private keys with software, then won't the software know how to get the private key? Any good software which is used to generate private keys should have some external source of randomness involved. The technical term for this is called a source of entropy. For example, the software might ask the user to generate a bunch of random movements with the mouse for 10 seconds. This initial source of randomness ensures that the software will never produce the same private key twice, or at least it will be highly improbable. Question: are attacks and defenses to cryptocurrencies all theoretical? Have any successfully occurred? Yes, in fact, there have been many cases of successful attacks on cryptocurrencies. These generally occur on smaller and newer blockchains which have not been around for as long. For example, in the summer of 2018, there was a 51% attack on Bitcoin Gold, a fork of Bitcoin. In this, the attacker was able to pull off a double spend attack by depositing Bitcoin Gold tokens on an exchange, trading them, and then effectively undoing the transaction with a 51% attack. And it's worth remembering that these attacks become exponentially more difficult on larger blockchains such as Bitcoin or Ethereum, and as of yet, none are known to have happened on them on the protocol level. However, on Ethereum, some applications have had vulnerabilities, such as the infamous hack on the DAO.
Will ASIC miners destroy Bitcoin? Is ASIC mining fair? ASICs introduce a trade-off between centralization and resistance to 51% attacks. Because ASIC miners mine at a hash rate that is exponentially larger than general-purpose hardware, they increase the barrier of entry to practical Bitcoin mining by raising the threshold to achieve profitability, which is a function of power usage versus hash rate. On the other hand, more computational power further deters the chance of a 51% attack, due to massive resources needed by one party to attain such computational power. Fairness is an inherently difficult problem, as blockchain consensus relies heavily on economic incentives and penalties. ASICs are a result of capitalism and innovation. Any algorithm can have an ASIC which is specialized hardware for a single task built around it. It all just depends on whether it is worth the economic investment to design such hardware. Currently, only the larger market cap tokens were worth building an ASIC for, but in a sense, no algorithm is safe from specialized hardware, as long as the economic incentive to innovate and overcome is high enough. Question: what is the purpose of decentralized Oracle systems, and which ones are in place today? The purpose of Oracle systems is to provide a source of data for decentralized applications so that they can interact with the real-world information. For example, if you want to power your home insurance with a smart contract, the contract would need to know whether your house is damaged, along with whether this was by accident or not. The big problem that needs to be overcome is ensuring that this source of data is reliable and that it is accurate. As of today, there are a few companies working on Oracle systems, such as Augur. However, they are in very early stages of adoption, and it is unclear how well they will work in widespread practice.